CNBC TV 18, celebrating 15 years of leadership.
Hello and welcome to Indianomics. It's credit policy yet again. A surprise cut came our way 2 weeks back. So what's the street expecting on February 3rd? We get you an exclusive poll. A bigger problem, however, that Governor Rajan will have to tackle is the Indian rupee. It has been the strongest performing currency in 2014 and was in December overvalued by 10% compared to a basket of 36 currencies who are our trading partners. How serious is the rupee overvaluation? That's a problem we will be asking Subir Gokarn, Sajjid Chinoy and Ajit Ranade in a bit. But first, the credit policy expectations poll of economists and bankers from Ritu Singh and Manasvi Gilani.
The man is known to surprise the industry, and he did just that by announcing an out-of-turn repo rate cut a fortnight ago. But that cut has trimmed down expectations of another rate cut from the central bank on February 3. Just 10% of bankers and economists polled by CNBC TV 18 expect a rate cut. And that 10% expect a cut of 25 basis points then. The majority believe that rates will remain unchanged this time, but they see the governor acting post the union budget. 55% expect RBI to announce 3 more rate cuts in 2015, taking repo to 7% by the end of the year. 35% expect 2 more cuts this year, while 10% see only 1 more rate cut coming their way. What else do finance guys expect in the policy? A majority said RBI will lower its CPI forecast for March to under 6%, while 35% expect RBI to keep the March CPI forecast unchanged at 6%. Only 20% see RBI cutting it to below 5.5%. But more than this, bond markets will be closely watching Governor's tone and guidance. 80% of respondents expect RBI to sound dovish this time, while 20% expect him to stay neutral. In fact, the words may be more important than action this time. In Mumbai with Ritu Singh, Manasvi Gilani.
Let's turn our attention to another pressing problem for the Reserve Bank Governor, the rising strength of the Indian rupee. Here's a brief look at the numbers. The rupee has been the best performing currency in 2014. From Jan 1, 2014 to Jan 30th, 2015, on a spot basis it has appreciated 1.4% versus the dollar, while every other major currency has depreciated. This record of the rupee has been partly because of the squeeze on gold imports and the fall in non-oil imports. India's current account deficit fell from $88 billion in FY13 to $32 billion in FY14, or from 4.5% of GDP to 1.7%. The other reason for the rise in the rupee in 2014 was the rush of capital flows because of a strong political leadership. Equity and debt flows stood at $45 billion from Jan 2014 to Jan 2015. These and other flows could well have taken the rupee to a 5% appreciation had it not been for aggressive dollar buying by the Reserve Bank. The RBI is believed to have bought $80 billion in spot and forward markets year to date in FY15. If one half of this was bought in the spot market, that's $40 billion. $40 billion worth of rupees sloshing in the system can be inflationary. So RBI absorbed 60,000 crores or $10 billion by selling bonds. Rupee appreciation may be a bigger headache for RBI in FY16. With the halving of oil prices, the current account deficit may be zero. If capital flows into equity and debt markets are again a robust $40 billion, the total BOP flows may be even higher. This will push up the rupee even more. This in turn hurts not just exports, it also makes it cheaper for an Indian shopping online to pick a Chinese good instead of an Indian one, thus hurting India's GDP and hurting Indian jobs. If RBI buys more dollars, it may increase liquidity, which can hurt its inflation control objective. Looks like in 2015, rupee appreciation may upstage inflation as RBI's biggest headache. So, in 2015, are we going to see a runaway rally of the rupee? And what does this mean for the economy and for the Reserve Bank? To discuss this, I have with me a star panel. As I told you, Dr. Subir Gokarn, former Deputy Governor of the Reserve Bank of India, currently Director of Research at Brookings India, Ajit Ranade, Chief Economist at the Aditya Birla Group, and Sajjid Chinoy, Chief Economist at JP Morgan. Gentlemen, welcome. Well, first let's lay out the numbers more clearly. Sajjid, what are you seeing in terms of the current account deficit for the current and next year, and more importantly, balance of payment flows?
Sure. Well, I think we have to recognize that with oil going from $100 to $50, that constitutes a massive positive terms of trade shock for India. Oil is India's single biggest import at 5% of GDP. In the current quarter, Jan to March, we actually project a current account surplus, the first time in 8 years. And for next year, even under the liberal assumption that, domestic demand picks up and growth picks up, and therefore non-oil, non-gold imports pick up, the global economy doesn't accelerate too much, and gold imports pick up because they've been liberalized, we're still projecting a current account deficit of only about 0.5% of GDP on average for the entire fiscal year, which is, a paltry $12 billion. Given the fact that India's more stable capital inflows are typically 55 to 60 billion, you're looking conservatively at a balance of payments surplus of at least $60 billion and possibly higher, given the magnitude of portfolio flows into India. So the central bank and policymakers will be faced with a significant problem of plenty in the next fiscal year.
Okay. Do you also have, therefore, an estimate of how much the rupee might appreciate, Sajjid?
We think that there will be very aggressive intervention by the central bank in the spot and forward market to try and prevent any kind of nominal appreciation for two very simple reasons. That, India, even though inflation is much lower, the real exchange rate will appreciate just by virtue of the inflation differential. Even if inflation averages 5% in India next year, global inflation is running at 1.5%. So you're going to get a 3.5 percentage point inflation differential, which drives real appreciation. You will most likely get continued depreciation of other trading partner currencies vis-a-vis the dollar, the euro, the yen. And so even if the rupee stays still, you're looking at both a nominal effective exchange rate appreciation, like the kind that happened in the last fiscal, which is going to compound the real appreciation. And if you have a real appreciation of 8 to 10%, that won't bode well for the tradable sector. So we think the RBI will do whatever it takes to try and prevent nominal appreciation. There are limits to how much you can intervene and sterilize, so we don't project much nominal appreciation against the dollar.
Fair enough. I'll come back to you with what the Reserve Bank can and will do. Dr. Gokarn, do you basically agree with Sajjid's position?
I broadly agree with Sajjid's analysis. I think we have to place this in the overall macro context. In a situation when the economy is overheating, when inflation is high, when growth is high, and interest rates are being taken up, an appreciating currency actually reflects and reinforces the overall policy stance. So you want demand to be compressed, and so it makes sense for the currency to appreciate. We're in the opposite situation now. We're in a situation where we can justify the resistance to appreciation in terms of the larger monetary policy stance, which is moving towards growth stimulus. Now, this of course raises the question of reserve accumulation and the question of sterilization, which you mentioned in your comments. I think when we're looking at trying to grow credit, keep in mind that credit growth has been extremely sluggish over the last few months. We're in a situation we're actually looking to grow credit. Sterilization is not a critical factor. I don't think we should be worried too much in the short term over the next 6 to 12 months about sterilization, because we actually want credit to expand. And to the extent that intervention will put more liquidity into the banking system, that is actually going to stimulate credit growth as well. When inflation becomes a problem again, and inevitably that's going to happen, but that's still a bit into the future, then we have to rethink the whole currency position, the currency stance, and start thinking of how
I agree.
Currency policy can reinforce monetary policy in terms of fighting inflation. But that is not the challenge, that is not the issue at the moment.
Yeah, we hope that is not the issue. If inflation throws up a nasty surprise, then the Reserve Bank's ability to buy up dollars and put rupees into the system will be curbed. But let me first finish the rupee appreciation argument and then come to the Reserve Bank's dilemmas. Ajit, like I told you, it's a appreciation of the currency per se by 1.5% over the last 13 months. Compared to some of our trading partners, it is 10% overvalued. As a person representing a business group, how bad is it?
As Sajjid pointed out, the domestic situation is that we still have an inflation, despite it coming down, is at around 5%. And he mentioned the tradable sector. So remember, imagine you are a spare parts manufacturer in India, supplying spare parts to automobile factories in Pune or Chennai, and the autos use steel and you sell it to Indian customers. So rupee business, rupee costs, rupee revenues. But you have to face the possibility of huge imports from abroad, especially, say, steel from China. And if your rupee is going to get stronger, you are automatically facing a disadvantage of competitiveness for no reason. I don't think the currency should fluctuate or respond in a volatile manner to capital flows. Especially what Subir was referring, if the capital flows are coming into the secondary stock market and the secondary debt market, if that is driving currency appreciation, we have to be very careful about it. Fundamentally, the rupee, the domestic currency, represents purchasing power of the rupee domestically, and this purchasing power cannot be totally out of sync externally and internally. So ideally, I'd like to see a rupee exchange rate which is somewhat stable.
No, you were giving us the example of the steel manufacturer who is buying domestic steel and supplying to a domestic consumer, but he will get hit because the imported spare part is going to get cheaper. So this is not only exports getting beaten.
Absolutely.
The local economy will start contracting because it is cheaper to import.
A large part of the domestic economy now is what is called tradable sector. So you may not actually be doing any imports or exports, but you're exposed to the external world. And incidentally, the extra dollars that are coming in, don't forget that India's foreign exchange stock is relative to its history is still low, meaning there is room to add top it up with $30-40 billion. So perhaps the Reserve Bank of India can look at its stocking policy of foreign exchange. There is room to do that. So there's a long way before the currency.
10% appreciation of the overvaluation of the currency compared to a 36 currency basket can be pretty harmful. A 10% disadvantage for an exporter or for a domestic guy.
Oh, absolutely. I mean, why 10%? Some of these profit margins in the tradable sector can be as narrow as 5%. So even a 5% swing in the currency wipes out your EBITDA or your profit after tax.
Okay, we have to take a break. Coming back with more questions on how the rupee appreciation can be controlled in 2015 and what are the Reserve Bank's options. Back in a minute.
CNBC TV 18, celebrating 15 years of leadership.